So, hello again. This is now a short video, I hope a short one, on the German existing CFC rules, the so-called Hinzurechnungsbesteuerung in the Außensteuergesetz. And this is the state of affairs before the ATAD rules have been transformed into German law, because although the ATAD had already to be transformed at the beginning or end of 2019 or 18 even, that has not yet been done by the German state. Not being done is now the state of affairs in the middle of 2021. Okay, so it is still relevant to show you the existing rules. What does the present German rule say about the participation quota which are needed to trigger CFC legislation? Here there are two variants of CFC legislation. First, it's a regular one that is defined in paragraph 7.1 ASTG, and it says when or under which circumstances you are subjected to CFC legislation if you hold a participation in a company which has passive income which is lowly taxed. The stricter CFC legislation refers only to income from capital investment in a low tax company, and under which circumstances that applies is regulated in paragraph 7 section 6 and 6a of the present version of the ASTG. That applies only or is only necessary if you are not already covered by the regular CFC legislation, because if that regular CFC legislation were to be applied, then it would also apply the income from capital investment, so there would be no need to practice that additional stricter one besides the regular one. Okay, so basically you can say first you test the regular CFC rules, and if they do not apply, then you test if 7.6 and 7.6a, the CFC legislation for capital investment income, applies or not. Now, the participation thresholds. Under the present rules of 7.1 ASTG, the regular CFC legislation takes effect if more than 50% of the voting rights of a foreign company are held directly or indirectly by taxpayers who are subject to unlimited tax liability in Germany. The important thing here is it is under the present rule not necessary that these shareholders are closely related to each other, or that they even know each other or even know about each other's existence. So if Mr. A has 40% of the Oasis Limited in a foreign tax haven country, and Mrs. B has 30% in the same company, and A and B both live in Germany, although they don't even know each other, the Oasis Limited is an object of German CFC legislation, because more than 50% of the voting rights are held by German-based taxpayers. So A and B, once they get the information from the fiscal office that their company is held to more than 50% by German-based taxpayers, they are both obliged to pay tax on an additional imputed income, the so-called Hinzurechnungsbesteuerung, for their proportional share in all the passive income of Oasis Limited. Naturally, if they already know before the fiscal administration informs them that the majority is held by German-based taxpayers, then naturally they also already have to declare all that immediately on their own. So an information from the fiscal office is not necessary, but would be helpful here if they don't know about the state of things. Well, in and as far a company has a passive income with capital investment, or with capital investment income character, then already a participation of 1% leads to CFC taxation for the individual shareholder. So there an additional imputed income will be assigned to that shareholder in the inlet. Here the 1% threshold refers to the individual participation of that shareholder. So in this case, the additional imputed income only covers the passive income from capital investment of the foreign company. Now, there is even one variant which is stricter. If the foreign company does only or nearly only have income with capital investment character, then no minimum participation at all is required. So indeed, a single share would be sufficient to trigger the CFC legislation and to bring along an additional imputed income for the shareholder. This last alternative is nearly impracticable if the stocks in the foreign company are traded in a stock exchange. So for this case, an official exception is granted. In other cases, if you have a 0.x percent participation in such a foreign company, you need to obtain the necessary data to fill out the German tax declaration about the company's passive income from capital investment, or with capital investment character to be precise. And how you obtain these data from the company with such a small participation is your own personal problem. Yeah? One would probably not accept that you just say, I can't get the data. One would always bring forward that you should not have bought the participation if you had no possibility to fulfill your tax obligations. Here there are some nice paragraphs or subparagraphs in the AO, the General Tax Code, which say nobody who enters into transactions with foreign states or entities abroad can bring forward that documents and proofs can't be delivered or can't be obtained if at the moment when you entered into that relationship you could have taken precaution that you could obtain them. And if that were possible or not with a small share, that could be at least a debate which ends up in court. One never knows. So there might be a certain deterrent effect which keeps you away from buying small shares in foreign companies which have relations to tax havens, and this deterrent effect might be at least seen with a smile by the fiscal administration. One does not know. Well, they would probably think, okay, it's your risk, it's your fun, why not? For the regular CFC rules, the relevant income is defined in paragraph 8.1 ASTG. And here we remember, at least I hope we remember, that the list of passive income was done with a useful trick. The trick is simple. We list everything explicitly which is not suspicious, so which is active. And every activity abroad which is then not on that list is automatically deemed to be passive, that is potentially subjected to CFC taxation. For the stricter CFC rules for capital investment income, the requirement is that first the income must naturally be a part of the passive income, so not active, plus it must fulfill the definition of capital investment income in paragraph 7, subparagraph 6a, ASTG. So, yeah. A last and most important condition is when or which tax is low enough to trigger CFC legislation. And that was originally, when the German tax rate was approximately 56%, it was 30% Later, when Germany's corporation tax was lowered to 25%, it was fixed at 25%. And then when Germany's corporation tax rate was lowered to 15%, it was still kept at 25%. At that time, the official excuse was that every German corporation would also be obliged to pay trade tax, and the trade tax usually would lead to a higher tax burden than 25%. Important is that the 25% threshold has to be determined on the basis of a comparison of the foreign tax, which is effectively paid, with the tax base as it is computed under German tax rules. So the official tax rate of the foreign country does not really count. It's perhaps an indicator. So if the official tax rate is only 1%, you can probably guess it will be a low tax country under A3. But if, for example, a foreign country takes an official tax rate of 40%, but then applies it only to 10% of the profit and declares 90% as tax-free, then it's clear it would only be an equivalent to a German tax of 4%, 40% on 10% of the tax base would only be 4%, so the official rates are not the thing which counts. Now, the official tax rate of Germany is only 15%. To demand a higher tax rate has been traditionally justified with the argument that every German corporation has also to pay trade tax, so that an effective tax burden of 15% would be too low. Now, the minimum amount of trade tax is 7% only. That is possible to obtain in 1 or 3 cities or villages or municipalities throughout Germany indeed. So that one could get away with 22% minimum tax within Germany. And so under the EU aspect, fundamental freedoms or so, it seems a bit excessive or arbitrary to say that we fight the possibility to shift income abroad if it's taxed at a lower level than 25%, if a tax level of 22% is tolerated within the own country. So that seems a bit contradictory, and that probably is one of the big issues which the German existing CFC legislation suffers from under European Union law aspects. Well, you remember also that there were court decisions, especially in the Cadbury-Schweppes case, where the Court of Justice said that applying a CFC legislation to a real existing company within the EU is not legitimate because it's a violation of the freedom of establishment, and that the only way out which can justify such a thing is that the foreign company itself is just a completely artificial construction, so that the freedom of establishment has not been effectively used and can't protect this situation. Now, the criteria under which the fiscal authorities would accept that something is not completely artificial, these criteria are not entirely clear. And paragraph A2 ASDG says, okay, CFC legislation is not applied to your shareholding in an EU company if it's not an artificial construction, but the problem is it's your burden of proof to bring proof that the foreign company is a genuine foreign establishment, and that creates enough legal uncertainty probably in real life to deter tax planners effectively from using such a firm for a tax planning model. Because if you have to fight for a tax advantage over 10 or 15 years in court and then get away with it or then lose, that makes the whole affair so unattractive that in all probability you will refrain from using it and look for something better. Yeah. Certain de minimis rules also exist. That means the rules about which trifles the law doesn't care. You know, de minimis Latin is for trifles. There is the old Latin standing expression de minimis non curat praetor. So about trifles, the administration doesn't worry. So CFC taxation is not applied if the case is of very low importance. The limits which the German rule has set is relatively complicated to apply. There are certain euro limits which limit the maximum extent of such generosity, so they renounce only if something which is considered as a trifle doesn't exceed a certain euro limit, and the surprising thing is that these euro limits have been fixed at the beginning of the 1970s and that these limits have never been, at least as far as I can see, that have never been adjusted to any inflation. So what was already considered as a trifle in the 1970s is now an absolute trivial amount in the 2020s. So nearly nothing will be ignored. The idea was originally that probably nobody would set up such an enormously complicated construction like a foreign-controlled company for such an amount. The idea, when that becomes to be attractive enough, that is now defined on the level of the price level from a time 50 years ago. That's probably a bit unconvincing. Well, due to the obligation to transform the ATAD rules into German law, the existing rules on CFC legislation are going to be changed in the near future, perhaps even this year still. A last draft, the third one, has been published in March 2021. And if that draft is not drastically changed, the intended legislation will deviate only slightly from the previous one. And that justifies why I still told you that legal situation of today. Some of the paragraphs and some of the details will be arranged differently. And so let me give an overview about the most important changes in the draft. According to the new paragraph 7.1, the regular CFC legislation will in the future only apply if an unlimited taxpayer controls the majority of a foreign company, either directly or via participations in others, either alone or together with closely related persons. So the difference will be now a regular CFC legislation will only apply if one person is the majority shareholder. In that case, the individual shareholder, so either the inland, let's say the inland shareholder or an inland subsidiary or a foreign subsidiary which owns the additional 20%, which together with the inland part of the group make up these necessary 50%. Every individual shareholder will be taxed according to his or her share in the foreign company under the CFC rules. So if a foreign company share is held indirectly via a foreign subsidiary, then the part of the foreign company will not be subjected to German CFC taxation immediately. If this share in the profit has already been subjected to the CFC legislation on the level of the foreign subsidiary, and the total tax burden has afterwards risen to a level which is no longer regarded as low tax level, then no CFC legislation for that share will take place, but only for that share which was held directly by the German shareholder. If not, then naturally it will take place. So then you have a two-step CFC legislation. First, the foreign state of the subsidiary applies its CFC legislation, and if then after the foreign CFC legislation the total tax burden on the tax oasis profit is still too low, then Germany comes in a second step and practices its own CFC legislation for the final shareholder until the total tax burden has reached an acceptable level. Well, the low tax threshold is intended to remain at 25%, which is, as we discussed just a minute ago, entirely unconvincing. Because we can achieve 22% without any problems inside Germany if we place a passive income corporation into a trade tax oasis within Germany. Regular CFC taxation does not take place if the taxpayer can prove that the foreign company is a real foreign company with economic substance, 8.2, and that this foreign company is located in the EU or in the EEA. That's an additional requirement. So that, to sum it up, 8.2 and 8.3 of the draft together simply say, if you have made use of the freedom of establishment and set up subsidiary in another EU state, you are out of scope of CFC legislation. Now, if you use an existing real subsidiary in another EU state to do some passive activities, then you run still the risk that the German administration says, well, the society, the company is real, but the investment is artificial. And this will have to be decided by the European Court of Justice. Because, well, I think if you have a foreign subsidiary, then this subsidiary has full freedom to do with its money what it wants to do. And so it's difficult to say that if you have an Irish machine factory, which then also invests some parts of its capital in low-taxed capital investments, then you can't really say this is now artificial. But this is going to be decided in 10, 20 or 30 years by the ECJ. One never knows, or perhaps even tomorrow. One doesn't know. The catalogue of passive income is, as far as the ministry seems to intend at the moment, nearly unchanged. Only some details will be adjusted. So in principle, same basic approach. And the stricter CFC rules, that variant for the capital investment income is, for reasons of clarity, moved to a new paragraph 13 ASTG draft, so you see more clearly that there are two variants of CFC legislation. Here again, shareholders will be subjected to CFC legislation for lowly taxed capital investment income in all cases, and that can even happen still, as before, if you hold less than 1% in the foreign company. A new detail will be that, according to the draft, also that stricter CFC legislation under paragraph 13 will not be applied in cases where the taxpayer can prove that the foreign company has a genuine business, like required by 8.2, for a majority-held participation. No, like required by 8.2. As 8.2 requires for the case of a majority-held participation. The additional request that this subsidiary must be, or that this company must be in the EU or EEA, is not demanded there. So that reflects that investment in foreign countries is protected by the freedom of capital, and that only artificial investments can be deprived of that protection. Now, the decisive problem here is that you can't say that a capital investment is artificial if the company which gets it is an artificial construction. I would rather dare to say that in most cases where capital is invested, very, very often you have artificial juridical entities which have been only created for the purpose of organizing that capital investment. So I would rather deny the adequacy of that approach. Probably one would have to say, you would have to prove that the foreign investment is not a genuine investment of capital, that the investment is entirely artificial, and that should be just judged from the perspective of what is usual in the market, because very often investment constructions seem to be highly complicated under juridical aspects, and nobody would say this is artificial. Only people from the tax perspective would dare to say that, but yeah, as it has already been held by the court in Schweppes already, that the mere fact that you make usage of a lower tax level in another country is not a reason to declare something as artificial, then the question is what remains in such cases. So that is highly problematic. Probably that escape clause here has a wrong approach and will have to be modified. Well, at least you see there has been some progress, that the at least you have now a kind of escape clause in these cases. Good. The next topic where we have to talk about is the general anti-abuse rule, and before we will also have to talk about some foreseeable future events in the area of CFC legislation, namely the global minimum taxation and the American GILTI tax.